Today we're going to talk about something a little bit different. We're going to talk about REITs. What does that stand for? Real Estate Investment Trust. We're going to talk about why they might make sense in today's market. We're going to talk a little bit about the structure. And really importantly, I'm going to talk about a REIT that I personally own. We've been buying for clients, the thought process of why, what are some of the things that it owns, and a lot more on today's Wealth Talk. Welcome to Wealth Talk. Today we're talking about REITs. So first of all, REITs is how they're commonly referred to. What does that stand for? Well, the R is for Real Estate Investment Trust. So a real estate investment trust is basically, just think of it like a mutual fund. It is a basket of different properties usually. It could be different mortgages. For simplicity, today we're not going to dive too deep into REITs, but what you need to know, it's a structure in which you could have publicly traded, sometimes private, ownership of real estate. Today we're going to really focus on what's called a publicly traded REIT. So a publicly traded REIT is something that you can buy just like any stock on the stock market. So you just got to have the symbol, you type that in, and you can buy it. The great thing that I like about publicly traded REITs is they're 100% liquid. What does that mean? It means you can sell them and get cash, right? And that's the nice thing. When you think about real estate in general, it's usually not a very liquid asset class. You've got to buy it. There's real estate commissions. You're definitely not thinking about selling real estate in a month or 2 months. And you shouldn't be thinking about selling real estate investment trusts in a short period of time. But what you need to know is they are liquid. So if you had to get cash out of these real estate investment trusts, it's just like trading any stock. You can go in, enter your order, and turn those into cash. So unlike traditional real estate or private real estate trusts, publicly traded real estate investment trusts are very, very liquid. So that's a very nice feature about them. Also, when you think about real estate investment trusts, what's important is when they structure them. So if you and I structured a real estate investment trust that we were going to buy properties in, the taxation of that, they're actually tax-free to the entity. So the real estate investment trust does not pay any taxes at all. And you're thinking, well, that sounds a little bit too good to be true. Well, not really. So the thing is, as long as they pay 90% of what they own, so let's say the rents the rents to their investors, you, me, and everyone else, then they don't have to pay taxes. And so what happens is that income that's coming in this case in the rents, that's going to their investors, the investors, you and me, when we collect the rent from the real estate investment trust at our ordinary income tax rate, that's where we're paying the taxes. So what that means is, unlike any other type of stock where you invest in a dividend, and that dividend is really based off of what the board decides and declares to pay to shareholders like you and I, a real estate investment trust, in order to maintain that tax-free status, has to pay us that income out. So we know when we invest in a real estate investment trust that we're getting a decent amount of income. And so when you think about that, income is something that's very, very challenging today. We always want to think when we're investing in anything, well, what is the risk-free rate? Meaning, if I'm going to invest in something, I always want more than the risk-free rate. The risk-free rate, what we always look at as long-term investors, is the 10-year government bond. And today, that's about 0.5%, which means for every $100,000 you give the government each year for the next 10 years, they're going to pay you a whopping $500. I don't know about you, but me giving 100,000, let's take that 10 times up. Let's give them $1 million. We're going to get $5,000 a year for a $1 million investment. I'm not too keen on that. So when you look at real estate investment trusts, you're getting a lot better income than that today. So I think to break it down and give you an example, I'm just going to talk about one that I'm using today. It's called Industrial Logistics Property Trust. The symbol's ILPT. And again, I personally own it, clients own it. Not a recommendation for you to own it. Do your own due diligence, talk with your advisor, see if it's something you want. purely for illustration purposes to show you the way the structure could work. So ILPT, Industrial Logistics Property Trust, and I'm a horrible artist, but these look like houses, but they're warehouses. And they've got these all over. These warehouses are in places like Hawaii. For example, Industrial Logistics Property Trust has about 267 properties. About 225 of those are actually located in Hawaii. Why I like Hawaii is because this is the land. Here's the mainland. Everything has to ship across over to Hawaii. So when everything gets across there to the port, it goes into warehouses, which is why Industrial Logistics Property Trust having a big location in Hawaii makes a lot of sense to me. So the other thing, what you want to think about, so first of all, I like it because it's warehouses. So you might think, well, Rob, why do you like warehouses? Well, think about what's going on in the economy today. Everything's being digitized. I'm in a high rise here in Los Angeles, Class A commercial space. You're seeing high vacancy rates. Corporations are downsizing. People are working from home. So I'm not really interested in investing in high rises today. What about shopping malls? We all hear the stories about companies like JCPenney's shuttering doors. Shopping malls are really hurting right now. I don't want to invest in a real estate investment trust that holds shopping malls. I really, really like this industrial space right now, because if you think about companies like Amazon, you think about companies like FedEx who are doing really well right now, they lead a lot of industrial warehouse space to put this stuff in. ILPT, two of their top biggest tenants are Amazon and FedEx. Another one of their largest tenants is a stock I've talked about before, Restoration Hardware. I have a client that just moved from Southern California out to Hawaii. Everything he purchased for that home was from Restoration Hardware that had to come here from the mainland or from overseas in China to Hawaii and went right into the Industrial Logistics Property Trust warehouse there. So I really like this type of real estate right now, industrial warehouse space. I think it makes a lot of sense. Logistically, I like the way that this portfolio is positioned, and I really like the income. We're getting paid 6%. So instead of $500, we're getting paid $6,000 on every 100,000. Or we talked about $1 million, where the government pays us $5,000 a year. ILPT pays us $60,000. Also, the nice thing about this is that when you think about a real estate investment trust, because it's real estate, for those of you who real estate have invested before, you have something called depreciation. So when you get that 6%, it's really like getting a 70% dividend, because only about 80% is taxable. So even though you're getting $60,000, you're only going to be paying taxes on about 80% of that. So again, another reason why real estate investment trusts make a lot of sense in today's market. Now, a lot of people say, well, everyone tells me just invest in the S&P 500 over the long term. Why do I need to think about these real estate investment trusts? Well, first of all, everyone who's telling you just invest in the S&P 500 is wrong. That's not what you want to do. You want to have a well-diversified portfolio. There's a lot of investments that have had equivalent or less risk than the S&P 500 that have actually outperformed. Our industry is selling you on that because it's easy for them. There's a lot of books written about that, but it just makes sense. Things are dynamic. What's a good investment this year might not have been a good investment 10 years ago and might not be a good investment 10 years from now. This is why you need continual education. You need to be engaged in understanding how to invest and manage your money. You need to have professionals like myself and others helping you navigate different environments, because government bonds, we talked about, 0.5% today. Well, in 2000, those are over 6%. So in 2000, well, we talked about the risk-free rate. If I'm getting, a little bit over 6% without any risk, why would I be so interested in real estate investment trusts or stocks for that matter? You probably wouldn't have been. So that's why when you hear people like giving you these rules of thumb of how to invest your money, it's absolutely preposterous, because how you should invest your money is dynamic. It changes all the time. The risk changes all the time. The opportunities change all the time, because if you just think about that risk-free rate, that's changing all the time. So you really need to take a look at that. But when we talked about, the S&P 500, if you invested $5,000 into the S&P 500 20 years ago, and 5,000 into the real estate investment trust index 20 years ago. And so the index is basically just like the S&P 500, which is 500 big companies. The real estate investment trust index is just a big index with all the different real estate investment trusts in there. But what happened is, if you fast forward that 5,000 20 years later, for the S&P, it did pretty good. It turned into $17,200. But for the REIT index, it turned into about $30,200. And that's really about the power of compounding of dividends. And so, first of all, there's a prime example of why you should be diversified. You shouldn't just blindly buy the S&P 500. Having some of your money in a real estate investment trust index really helped not only decrease the rate of risk that you had in the movements, but it also gave you a better rate of return. And it also shows that when you're collecting those dividends, just like we've seen in the stock market, it's extremely important for you to get that money, and to actually, sometimes if you can, not just take that money, but reinvest it back in. And that's what really gives you that compounding effect. So again, today, this isn't an in-depth discussion about how to analyze real estate investment trusts. That's things that we're going to talk about in the future, but it's something to be aware of. In today's volatile market, people are a little bit scared about investing in stocks. They might not have the money to invest in a quality portfolio on their own of real estate. Most investors can't go out there and individually buy the warehouses that are being leased to FedEx and are being leased to Procter & Gamble and Amazon, like you're getting an ILPT. But for as little as, really, if you wanted $500, you can go into your brokerage account and buy yourself a few shares of ILPT or another real estate investment trust that makes sense for you. So this is just, again, to show you it's not all or nothing. There's a lot of opportunities out there. When we're just, hearing all this noise about 30 days away from an election and you're a little bit worried, and when you're looking at your money market rates yielding next to nothing, there's other alternatives out there. So today, this is just a little brief example about real estate investment trust. You now know what they are. Go out there and look at some, see if there's some that make sense for you. Until next week's Wealth Talk, I'm Rob Luna, signing out. Until next week, continued good health and good wealth. Have a great weekend. We'll see you next Friday.